For some time now, President Trump has been pushing for lower interest rates and more economic stimulus. However, the Federal Reserve has repeatedly pushed back. The current chair of the Federal Reserve, Jerome Powell, has a term that expires in May of 2026. Recently, President Trump announced his pick to lead the Federal Reserve moving forward, and that person is Kevin Walsh. That announcement is what triggered the sharp drop in gold prices, the decline in silver, and the pullback in Bitcoin. The reason is tied to how investors think about assets like gold. Gold is often purchased when people are worried about the US dollar because it acts as a hedge. Unlike stocks, gold doesn't generate economic value. When you buy shares of a company like Amazon, you expect it to grow, innovate, and generate profits. Gold, on the other hand, simply sits there. It doesn't produce income. It functions more like insurance. People tend to buy gold when they're concerned about inflation, economic instability, or the dollar losing value. That's why gold is considered a protective asset. Over the past 5 years, gold has outperformed the stock market, and silver has actually outperformed gold, which is unusual. Historically, gold only outpaces stocks during periods of serious economic stress. We've seen that happen during the Great Depression, in the early 1970s during stagflation, after the dot-com bubble burst in 2000, during the 2008 financial crisis, and now in the post-pandemic era. When gold rises faster than stocks, it usually signals fear and uncertainty, and that's exactly what we've been seeing. One of the main reasons for concern around the dollar is massive government spending. When the government spends heavily, it often creates money out of thin air. That process devalues the dollar and pushes prices higher, which we call inflation. That environment naturally drives people toward gold. On top of that, foreign countries like China, Poland, and Turkey have been increasing their gold purchases. More recently, another major driver of gold and silver prices has been uncertainty around the future of the Federal Reserve. President Trump has repeatedly called for extremely low interest rates and has said he wants the United States to have the lowest rates of any developed nation. He has even floated the idea of 1% interest rates. He's also stated that he does not believe the Federal Reserve should be independent from the government and has suggested it should take direction from the White House. All of this created anxiety among investors. The fear was that a new Fed chair might follow those demands, weaken the dollar, flood the economy with new money, and trigger a dollar crisis. In that scenario, gold would become even more attractive. However, when President Trump announced Kevin Walsh as his pick, markets felt a sense of relief. Walsh previously worked at the Federal Reserve during the 2008 financial crisis under Ben Bernanke. At that time, he was known for supporting higher interest rates and opposing excessive quantitative easing. He was concerned about inflation and was not in favor of aggressively lowering rates. Today, Walsh has said he supports lower interest rates, but with balance. His argument is that inflation risks from lower rates can be managed by tightening the balance sheet and pulling money out of the economy. Because of that, investors view him as more level-headed and disciplined. Wall Street sees him as someone who wants to protect the value of the dollar rather than recklessly weaken it. In addition, his past experience has led many to believe he will defend the Federal Reserve's independence. Walsh himself has publicly said that independence is important, even while acknowledging the need to work with the White House. That calmer, more balanced stance reassured investors that the dollar may not be harmed as severely as they feared, and that inflation may be more contained than originally expected. That shift in sentiment is what triggered the sell-off in gold and silver. There's also a psychological component at play. Gold and silver prices surged dramatically, especially silver in late 2025 and early 2026. After such rapid run-ups, speculative buyers tend to flood in, many without fully understanding what they're investing in. When prices start to fall and headlines turn negative, those investors panic and sell, which accelerates the decline. This brings us to what all of this means for you as an investor. I want to be clear. On Monday, I'll be releasing a full video breaking down what this means for the Federal Reserve, Kevin Walsh's potential policies, and the broader economic impact. But right now, I want to focus specifically on gold, silver, and Bitcoin. The way investors build wealth is not by chasing hot assets. It doesn't matter whether it's stocks, gold, Bitcoin, real estate, or anything else. Every asset goes through cycles. The people who succeed are those with a well-structured portfolio that fits their goals and risk tolerance. Gold does rise over the long term, but it doesn't move in a straight line. History makes that clear. After the 2008 crisis, gold surged because of aggressive money printing and interest rate cuts. Investors feared inflation and currency devaluation. But once it became clear that hyperinflation wasn't happening, stocks recovered and gold declined for years, from 2012 through 2020. Then in 2020, the pandemic hit, rates were cut to zero again, money printing returned, and inflation fears resurfaced. Gold broke new highs and continued climbing. Between 2020 and 2025, prices stabilized as inflation was brought under control and rates increased. But when new concerns emerged about Federal Reserve independence and leadership, investors once again turned to gold for safety. Now, with Kevin Walsh's nomination, many believe the dollar may remain stronger than expected. As a result, investors feel more comfortable shifting back toward traditional investments rather than heavy allocations to gold. This shift also impacted Bitcoin, which many people treat similarly to a tech stock rather than a true hedge. Does this mean you should panic or drastically change your strategy? No. The biggest mistake investors make is reacting emotionally to headlines. They hear a news story, watch a video online, and immediately change their portfolio. That's not how wealth is built. You need a clear strategy that fits you. If gold is part of that strategy, great. If it isn't, that's fine too. Some people build wealth with stocks, others with real estate, others with crypto. Success isn't about copying someone else, it's about consistency and discipline.
Assets generally rise over time, but real wealth is built by avoiding emotional decisions. Financially savvy investors pay attention to where money is moving without panicking. When markets fall, they see opportunity rather than fear. Panic sellers, on the other hand, often end up selling to smarter investors at discounted prices. I'm not saying gold, silver, or Bitcoin are right or wrong for you. I want you to understand the forces at play because these shifts affect the entire economy. On Monday, I'll go deeper into what this means for the dollar, the stock market, and the broader financial system. Because gold and silver have been such hot topics recently, I wanted to address this immediately. If you want to learn how to research investments and identify opportunities before they hit the headlines, I've put together a free investing masterclass. The link is in the description below. When you sign up, you'll also get free access to my daily market brief newsletter, which reaches hundreds of thousands of investors. And if you found value in this video, the best way to say thank you is by sharing it with a friend, family member, colleague, or fellow investor. That's how we continue spreading financial education. Thank you.